Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. So how else is your week going, Luke McCarty? Everything else going pretty good?
It's going good, minus the stock market.
Okay, talk to me about that because it's been in the news a lot over the past week and a half. What's going on with the market?
Yeah, so the stock market's starting to soften a little bit, right? The S&P kind of peaked earlier this year in September, up about 20% for the year. Now it's down around, 10 to 15, depending what day you look at it, right? So it's kind of fallen off a bit. A lot of the gains built into the market's fallen off. Interest rates are rising, so your big tech names are getting hit. Your growth stocks are getting hit. Oil's going up, so your Exxon Mobil's and things like that are doing well. Financials are starting to do well, but kind of your FANG, right? Your Facebook, Apple, Amazon, Netflix, Google, right? Those are getting hit harder because of rising interest rates, and they're just a growth stock kind of in a market that's kind of trending down at the moment.
And the one thing that we always worry about is why. When we look at our fundamentals, there's nothing that suggests that it should be doing this other than what Luke just mentioned right there. But when we look at our data sheets and so forth, they're still really good. Everything is, other than one sector, we are positive all the way across the board. Mm-hmm. But we've been talking the last month or so, how do we protect from some downside risk? And you never know what's going to start that process. You never know. But once that bowl starts rolling and catching momentum, it can be pretty dramatic. So trying to just, mitigate some of those things.
Art McPherson, what advice would you give someone who gives you a call to the McPherson Financial Group and says, this shaky market has me on edge?
Well, most of the things that we do for our clients is we do what we call a maximum market risk assessment with them. And we want to make sure that if they go through a correction like 08 and 09, where it was huge correction, 40, 50%, that our clients are not going to be exposed like that. So almost all of our clients are already protected. But Luke and I are looking at other ways to protect some of the money that is at risk, some of the money that is still in the market. We want to have a good outcome regardless of what our clients are invested in. But our clients don't really have to worry.
Yeah. Now, is that part of also, because we'll talk about it here coming up in a couple of minutes, that the team at the McPherson Financial Group want to offer a complimentary second opinion this weekend, that maximum drawdown risk. Is this something you can sit down with us as part of that second opinion and help put together a strategy?
Absolutely, because we all love the market when the market is doing well. Mm-hmm. But we don't love the market when the market is not doing well. So right. It always is scary. Mm-hmm. And it always comes at a time when all the news is negative. So you turn on the news, you turn on the financial reports, you turn on all that, everything starts compounding. And the TV is just a reassessment of, look, this is how bad things are. Look, so it makes you want to react emotionally. Mm-hmm. That is the wrong thing to do because most investors will do that. Most small investors will react emotionally, not technically, and that's where you usually get burnt.
And so we're talking a little bit about this time of the year and how the market's acting a little bit shaky, and Luke was talking about how inflation is up, and we're kind of in that fourth quarter. We're talking strategy, and so as we head into the fourth quarter of the year, now we're hoping that markets keep holding up, as Luke was talking about, but CNBC asked Goldman Sachs' David Kostin what potential threats he sees to our investments.
I think the biggest risk out there is taxes. We are assuming that taxes on the corporate level are going higher. And so that would lead the risk to potential negative earnings revisions kind of as you look later into the fourth quarter, once the tax legislation, the tax hikes are coming into place.
All right, that was David Kostin on CNBC. So, Luke McCarty, I'll ask you, what are some of the tax moves that we can make now that might help us with our investing strategy?
Right, definitely. So when looking at taxes, right, what David was saying in the interview from Goldman Sachs is that, he's worried about corporate tax rates increasing, right? Well, historically, what happens when corporate tax rates increase is they pass on the cost to us, right? Us as the consumer, or maybe us as the employee, not getting not getting as much of a raise, right? You're essentially looking at the tax code, right? The new Biden tax plan of adding an additional 5% onto the corporate tax structure. Well, that's going to be 5% less earnings, 5% less net income. So there's some things you can do now to kind of prepare for that, right? I mean, we're seeing inflation now. I hope the rising tax rate does not increase inflation even further. But if I was a corporation, you could pass down that to your consumers. But, you need to look at Roth conversions this year because they're trying to limit them and limit the tax brackets and who can do Roth conversions and when. And they're trying to also remove Roth conversions totally by 2031. So if we're thinking taxes are going up next year, you only have 10 years to do conversions. If it all plays out, well, you should take time this year to do one this year at a lower tax rate.
And basically, one of the things that we advise people to do, anytime you hear rumors or we have the conversations on TV like you see right now, Biden has talked about raising taxes in a lot of different areas. That's always a negative thing because you're taking profits away. So if you're going to take profits away from a corporation, the market starts analyzing that and building that into the pricing. So that's why they get concerned about that, because if Home Depot is killing it this year, how much is a tax increase going to affect their bottom line next year? So the market is looking for opportunities to either buy or sell. And if it feels like now is a more expensive time to hold that security and they think they can get it at a discount later, they'll sell it. So you'll have that sell pressure. Right now, we have over $1.5 trillion sitting on the sidelines because there's been a lot of people, rather than reinvesting right now, are waiting a little bit. So that's magnifying our current problem. So anytime you get these pauses of money being reinvested or money being reinstituted, we'll see that softening. You'll see the sell pressure.
So we saw over the past couple of weeks, they're still trying to pass that infrastructure bill, that $3.5 trillion increase. And they're saying, oh, it's not going to cost you anything. This is going to cost $0. Well, maybe so, but it's going to cost us because, as you just mentioned, everyone's going to have to raise the prices to pay for the increased taxes. Is that one way of looking at it?
So I think they do believe in a real money tree.
It's somewhere out there.
I mean, is that what she just said?
I think that's what they think. You tell me. You know better than I do.
Because the revenue for the federal government to spend comes from Mark Owens,
right,
Art McPherson,
right,
Luke McCarty,
right,
and the rest of the country. And then when they spend too much, they have to borrow over and above what they have in tax revenue. Well, they just had to do something last week, which is raise the debt ceiling because they're borrowing too much. You, when you borrow too much, your credit card company will probably say, Mr. Mark Owens,
stop.
You are making minimum payments and we're going to drop your limit from $20,000 to $10,000. Our government, they go, oh, we're just going to increase the limit. They don't have any kind of reservation right now. And I don't care if it's a Republican or a Democratic side. They both are moving in the same direction. And it's really scary, but they're not going to be able to do it forever because it is not a money tree.
So you're saying I can't call the credit card company and say, just raise my limit, I'm good.
You can. If your credit score is well enough, you actually can get away with it for a while, but there will come a time where the credit card company goes, okay, you just opened 3 new credit cards. You've now max funded them, and now you want us to raise your limit? We think your debt to income ratio is a little bit out of whack. If we held our government to the same standard, we could be in really good financial shape right now, but nobody has. Nobody's put the feet to the fire to them.
Yeah, so if you think about it, the government is the credit card company, right? The credit card company is raising their, they're basically creating their own rules, borrowing money from themselves and raising debt limits. Whereas in this scenario of you borrowing money, Mark, you have to get permission. You have to get approved. The government's approving themselves to spend more money with their own money that they don't have. So not going in the right direction.
I saw a meme that it said, if your basement is filling up with sewage, what do? You clean the basement and you get the sewage out. Well, what does the government do? They just raise the roof so it can continue to fill up with more sewage.
That's about a good analogy.
Is that a simplistic way of looking at it?
That's a great way to look at it.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.